Hello and welcome into the KE Report. I'm your host, Shad Markowitz, and I'm speaking today with John Rubino. And you can follow along with John over at his Substack page. He puts out a newsletter several times a week just discussing the macro markets, some of the stocks in his portfolio, some of the topics of interest as far as what's going on in the health of the economy, and some of the maybe warning signs across the bow that we've seen despite the jubilant nature of the markets lately. And John, it's always great getting you on the show just to pick your brain. I've been following along with your Substack page and some of the articles you put out, and I'm curious to see how you counterbalance, let's just say, the market jubilance that we've seen in everything, whether it's the general market equities in the Nasdaq or the Dow or the S&P 500, the small cap Russell 2000 stocks finally moving up in a big way. We've seen the cryptocurrencies continue to take higher leaps forward. We've seen it in the commodity sector. And it's all counterbalanced against the dollar having pulled back and interest rates having pulled back because Powell has been messaging to the markets that he may start looking at rate cuts next year. What do you make of the basically sugar high rally that we've seen, the Santa Claus rally, almost all across the board the last couple of weeks of the year here?
Hey, Shad. Well, yeah, there's an awful lot going on right now, especially for the end of the year when nobody's paying attention. But I think in the Fed's case, two things happen. One is that there's a lot of underlying statistics that are pointing downward. In other words, yeah, the big headline numbers like GDP growth and stuff like that are still okay. But, credit card spending is starting to roll over after spiking in the last couple of years, and credit card defaults are up. And as you and I talked about before we went live, a lot of companies are reporting bad predictions about 2024 because of that. They're seeing weak sales. And Hasbro, for instance, the toy manufacturer, just laid off 1,100 people, which is something like a third of their workforce. And the Fed is seeing all that and is definitely now more interested in cutting rates in 2024 than raising them. And the other thing that probably happened is that the Fed got a phone call from the White House saying, you know what, this is an election year in 2024, and if you want any kind of a future hanging out with the establishment, you better not be raising interest rates going into this election. And I think the Fed heard that. So you put it all together, and we've got probably a recession coming next year, and the Fed is going to have a very good excuse to cut pretty aggressively during the year because it's got an election year and a recession going on at the same time. So I think the rally in stocks was a relief rally, obviously, but probably a misguided relief rally because it's taking into account maybe lower interest rates going forward, but it's missing lower corporate earnings, which are going to go along with and be an excuse for the lower interest rates. So I would say the people who short the market today will do better than the people who are going aggressively long.
Well, John, just to that point, it seems like a weird mixed message for the markets to jump for joy and surge higher on the idea that the Fed will be cutting rates next year, when the reason that they'll be cutting rates is because there obviously is some weak data under the surface that they're looking at. Even in their dot plots, they've got some messaging that they expect to see tougher times in the quarters to come. So they're trying to get ahead of that. Does it seem like a weird thing that the markets are rallying on the fact that we're going to have bad news next year?
Yeah, but markets do weird things all the time. Mr. Market is a manic depressive, and sometimes he'll be depressed and sell you things at incredibly low prices, and other times he's manic and buys at insanely high prices. And I think this is one of those times because the S&P 500's PE ratio is something like 25 right now, and during recessions it gets down to 10 or lower at times. So there are some air pockets under the big stocks out there now. Now, what's interesting for us is that the overall market, especially big tech, but also a lot of other sectors, is based on historical measurements overvalued. But the mining sector, especially precious metals, is really beaten down. It's one of the cheaper sectors in the market right now. And historically, it's very cheap compared to what it used to be. For instance, the miners in relation to gold are down pretty dramatically. So I think, in a recession, even if it's brings an equities bear market along with it that pulls everything down, the miners are less at risk than, say, big tech would be right now. So I think, I wouldn't go out on a limb and say that gold miners are safe havens in a recession, but I think they're less at risk than they would be if they had already had a nice run. Now, having said that, the last couple of weeks have been kind of nice for precious metals and for the miners. So it would be nice to see that continue for a while. And, that for me is the tricky part, because if this is a relief rally in the overall markets and it's going to be reversed out by a recession, lower corporate earnings, and an equities bear market at some point in the future, not sure you want to be buying anything. But boy, some of these miners look extremely cheap based on their operations.
Well, it's an interesting point you make, John, because when you look at the PE ratios of even some of the biggest mining stocks, they're nowhere close. They're not even in the same stratosphere with the tech stocks or some of the growth stocks that have much higher PE ratios, as you mentioned, the price to earnings. So if the earnings start falling in some of those mega cap stocks or even some of the standard stocks that you would find in the S&P 500, if those earnings start falling, they have a lot more room to fall than, let's say, the mining stocks do. But to your point about the disconnect, gold continues to have held up well really most of this year. There were some gyrations, of course, but we're ending the year here well above $2,000, pretty close to all-time highs. And the mining stocks still have so much room to go to even get close to the valuations we've seen, even at the same price level several times in the past, not to mention where things were in the last cycle at even lower prices. So what do you make of the continued disconnect between the gold equities and silver equities and where gold and silver are actually trading?
Well, my explanation for that is that it takes a long time to change people's minds, and people have been kind of bored and or disappointed with gold lately, because it's bounced off 2000. It hit resistance at 2000 maybe 4 times in the last 3 years, because it did it once just lately before it broke through. And that's the kind of thing that leads people to stop paying attention. So nobody was excited about the sector, therefore the miners didn't catch a bid in any meaningful way. But let gold stay above 2000 for a little while so that people start thinking that 2000 is now support instead of resistance. And then they start thinking, well, what is resistance? Maybe it's 2500. That's a little more exciting. And that could easily lead people to go back to the miners and say, okay, you're profitable at $1,900 gold. So what are you at 2,200 or whatever? And the answer is extremely profitable, incredibly cheap based on the cash flow that would result if gold stayed in the low 2000s. So the longer it stays above 2000, the more that thought process makes sense. Because, investors basically just extrapolate their recent experience into the indefinite future. That's how most predictions and most buy and sell signals happen. So the longer gold stays above 2000, the more likely it is that people are just going to start extrapolating higher gold price into the future and then translating that into higher cash flow estimates for the miners. And, that's how a bull market can get started for these guys. So it all depends on gold staying as high as it is. And, central banks are helping for the first time in a long time. They became net buyers of gold a few years ago and became aggressive net buyers of gold in the last couple of years. We might have another 1,000 tons of gold get taken off the market by the central banks this year. It's a really big number in the context. And, if that continues, that's a big win that gold's back. And it used to be a headwind, and now it's a tailwind. And that's a big deal. So it doesn't take much added investment interest in gold to push it up from here. So, there's a lot of reasons to be optimistic about precious metals. The only negative that I see now is that there's an equities bear market coming, and that's liable to pull gold and silver down for a while. But I think the fundamentals are great. The fact that central banks are net buyers now is phenomenal. And I think that a lot of the miners have been pretty cautious, actually, with M&A and stuff like that. So they're in pretty good shape operationally. So you put all that together, and if a mining bull market doesn't happen right away, it should almost certainly happen when the Fed really starts cutting interest rates in the face of an equities bear market and a recession. So we could be looking at like a 2009-ish kind of environment next year. And what followed 2009 was great for precious metals. So I think that's completely believable, possible scenario for the next few years.
Yeah, John, it's an interesting point too, because if we see inflation starting to moderate, we've seen fuel costs come down, we've seen the cost of cement and lumber, explosives, chemical reagents coming down. At the same time, if we see metals prices increase, then instead of it being a story about margin compression, it'll be a story about margin expansion. But another thing that we watch really closely here at the KE report is just how investors react to news. And really over the last couple of years, it didn't seem to matter how good the news flow was out of some of these companies. It was ignored or shrugged off. And at least over the last couple of weeks, in tandem with everything rallying, it seems like for the first time in a while, positive news was actually bought. It actually felt like bull market action for the first time in a long time. What do you make of the sentiment change and the sea change we're seeing with investors, I guess, starting to respond more positively to good news from companies?
Well, that's one of the ways you know you're in a bull market is when good news is treated like good news, because for the miners especially, it's been ignored for the past couple of years. There are some explorers out there that have been reporting phenomenal drill results, and their stock prices have gone nowhere. And normally, in a normal market where people are paying attention and they're excited about the future, those kind of drill results get a really good pop for the stock. But just lately, among the companies I've been watching, Eloro Resources, i-80 Gold, and Southern Copper have seen pretty good news, and it's been treated that way. Their stocks have been bid up fairly dramatically in December. Eloro and i-80 Gold had really good drill results. And as I was saying, the markets haven't cared about stuff like that for the longest time. And this time, the markets liked what they saw, and those two stocks went up. And Southern Copper, there was bad news in the copper mining market when the Cobre Panama mine got closed down. This made the price of copper go up a bit, and Southern Copper went up much more than the price of copper did. So that's another example of good news fundamentally leading to a big pop in the stock price. So that's a sign that sentiment in commodities is starting to change, and people are starting to respond to good news in the way rational investors do, finally. So hopefully that keeps going, because there has been a lot of good news coming out of the mining sector lately that's been ignored. And if that good news keeps coming, maybe it won't be ignored anymore, and maybe these stocks will catch the kinds of bids that they really ought to for what they're doing operationally.
Well, another thing besides some of the positive news finally getting recognized is you brought up mergers and acquisitions just a while ago. We haven't seen a whole lot of it, and that's true. We really haven't, except for the largest companies acquiring the other largest companies, the big boys acquiring the big boys, like Newmont acquiring Newcrest, for example. And there was some base metals consolidation with BHP and a couple of the big giant companies gobbling up other giant companies. But just recently, John, we've seen a string of smaller deals. We've seen things like Caliber taking over Marathon. We've seen Nighthawk and Moneta combine forces. We've seen Adventus and Luminex combine, a gold copper company. Speaking of copper, we've seen a couple smaller deals, and we've even seen almost a bidding war start for OreCorp, where Silvercorp made an offer on it, and then Perseus Mining came in and took a 20% stake and said, oh, no, you don't. And so we'll see how that resolves. But do you think we'll start seeing more action like this, more M&A action, more of the larger companies coming down and bolting on another mine or developer? Or do you think we'll see developers combining together to form larger companies of mass? How are you looking at the M&A space?
Well, I think everything you just mentioned will probably happen at some point in the not too distant future, because a lot of these little companies are still having trouble getting financing. And so one of the solutions for that is for several of them to merge into a big enough company to be able to sit at a table with a banker and make a case that might actually be persuasive. But at the same time, the really big miners aren't replacing their resources in a lot of cases. They're taking more out of the ground than they're discovering with their own exploration. And so they don't want to just zero themselves out and cease to exist, and they have to get more reserves from somewhere. And so they pretty much have to buy out the highest quality exploration and junior miners out there. So you would expect that to happen. And it's going to happen on a bigger scale the more optimistic the market gets. So that requires the stuff we were talking about, gold to stay higher for a while, and people to start interpreting good news as actual good news. And then the CEOs of the 5 or 10 biggest miners are going to start calling their people in and going, okay, it's time for us to grow now. I want to build that empire that we've been talking about. And so there will be bidding wars and really big premiums paid for a lot of these little guys, which is a mixed blessing. I mean, it's nice when somebody buys out one of your explorers at double the current price. But if you're thinking of it as a 10 bagger and all it does is double, then that's bittersweet, right? And that could be the kind of thing that we see. And hopefully the way it works out is that the first few deals where it's double the current price, let's say, gets everybody excited and they start looking at who's next. And then a lot of new money comes in and really bids up the remaining takeover candidates. So we still do get some 10 baggers out of this process. We just don't get all 10 baggers the way I'm hoping for. But in any event, it's a really good environment that could be coming. And again, it just depends on gold staying high for a while. And let that happen and everything else will fall into place.
Well, John, another sector in the resource space that's had a pretty good year and has been getting some traction, and it's something I know you follow along with, is in the uranium sector. We have been following along as well here, and it's interesting to see that the uranium spot price has really been one of the commodities that's broken out this year, and the mining stocks have followed. Some have noticed that the uranium mining stocks, though, aren't really tracking just how aggressive the moves in the metals have been with that typical outperformance you see. Do you expect the uranium mining stocks to catch up a little bit to the moves we've seen into the spot price and term pricing, or do you think that things have gotten a little overheated and maybe we're getting a little ahead of ourselves with the uranium mining stocks and the uranium sector in general?
Well, I think mining is a tough business. For instance, Cameco just lately announced that they were going to produce less uranium than they originally projected because they're having trouble at a couple of their mines. And that's the kind of thing that you have to take into account with the mining sector. It's just a hard business right now. You've got countries changing the rules, like with Cobre Panama in copper, and you've got coups here and higher taxes over here. And it was never an easy business to operate, but now it's harder than it used to be. So that makes people a little more reticent about miners. But man, uranium is just rocking here. And there's no reason to think uranium stops being a strong market anytime soon because there are so many new nuclear plants coming online and they've got to be fed, which means uranium has to be gotten from somewhere. And geopolitics being what they are right now, countries like the US want the uranium to come from nearby. In other words, Mexico, Canada, the US, rather than from, say, Russia or some country in Russia's sphere of influence. So that makes the local deposits that much more valuable. So I think the miners eventually will catch up to uranium and pass it. They'll behave like the leverage plays on the underlying metal that they are. But there's just a few other factors to consider right now. But we shouldn't be complaining at all about the mining stocks in that space because they're the best miners out there right now. 60, 70, 80% gains in the last year are really nice in context because you're not seeing that in any other mining sector as far as I know. So, uranium is probably a bull market for the next 10 years on and off. There will be corrections and things like that. But I think it has to go to a much higher price, even from where it is now, which is like $90 a pound, up from $30 or $40 a pound a year ago. But the people within the space are saying that it has to be higher than that to bring out the supply that's going to be necessary to feed all these new nuclear plants coming online. So, and that's not cyclical because these plants are being financed and they're being built, and that really it's not affected much by the business cycle. So you can have a recession next year, and that won't appreciably change the number of nuclear plants that come online in the next 5 years. So I think uranium is going to see strong demand basically as far as the eye can see. And as Rick Rule likes to say, the easy money has been made in uranium with this last doubling, but there's still a lot of money to be made going forward. It's just not easy money anymore. So it's a good space to be in. I think everybody should own some uranium stocks, but I don't think you want to be betting the farm on this sector now just because it's had a good run lately.
Well, John, just to that point, yeah, it's definitely one of the few bright spots from this year in the commodity space. And in my own portfolio, even, I hold 8 uranium stocks personally. It's been some of the only ones in the green on certain days. So definitely not complaining, but I've noticed it's mostly the largest companies. It's the producers, the prior producers, or the near-term producers that have had most of the action. I guess my earlier comments were in reference to a lot of the exploration stocks or the earlier stage projects trying to build out pounds in the ground of uranium. Those haven't moved as much as, let's say, the biggest companies have. When you're playing the uranium space, are you sticking with the tried and true names, the biggest and the best, and the producers and near-term producers? Are you looking at the exploration stocks? How are you playing the uranium space in your own portfolio?
Well, early in the bull market, money flows into the recognizable names, right? If you're somebody who just doesn't know anything about the sector and you call up your broker and say, hey, I want a uranium stock, he'll get you one of the big 3 or 4 ones, right? And then as time goes on and the big ones go up, people start looking around for, wait, what mid-tier is going to act like Cameco now, and so on. And so the money flows further and further down the food chain. And the time will come for the uranium juniors. But right now, most of the attention is being paid to the big guys. And so that's where I am too. I own mostly the big ones. And then, there's one way to participate early on. I think Sprott has a junior uranium miner ETF. And something like that is a good thing to look at early on when you really don't know the juniors very well in a space yet, which I think is the case for a lot of investors in the uranium miners right now. They know the big names, or at least they've heard of the big names, but they're clueless about the little guys. And so you can start giving yourself some exposure to that with an ETF, and then look at the holdings of the ETF and use that as your research list and gradually get more and more competent, because in any space, especially the explorers, are lottery tickets. Even if you're in a bull market in that space, most of the exploration companies will never amount to anything. And unless you're really familiar with the industry and are able to separate the wheat from the chaff, it's really a dangerous thing to say, okay, this is a hot industry, let me buy the juniors randomly. And so you don't want to do that, even with uranium juniors, even though that's probably a bull market for a long time. You still want to be able to buy quality names down there on the lower rungs of the ladder. And to do that, you have to put a little bit of studying into it. So start with an ETF that's done some of that for you. And then over time, get more and more conversant in the industry and the technical terms and the best players down there. And then you can start building your own portfolio. But I'm not there yet personally. I just know the big names, and that's where I am.
Okay. Yeah. And to your point, you can get into an ETF like, I think you were mentioning URNJ. That's the Sprott Junior Uranium Miners ETF.
Yes.
URNM is their bigger one that has the Cameco in it and the Kazatomprom and even the Sprott Physical Uranium Trust. That's all inside URNM. But URNJ is those smaller names in the space, and somebody else that manages that index has already done a good job of culling the herd to figure out who should be in that. So that's a good place to start people's research. I guess as we wrap up the year of 2023, John, and move into 2024, are there any other high-level thoughts on investing in the resource sector or investing in general that you'd like to leave investors with here today?
Well, I think protection is a good thing to be thinking about right now, because no matter what you own, 2024 is potentially a scary time for what you've got. I mean, whether it's, I don't know about bonds, but I think most stocks are in danger going forward. And I think, this is a time to look at shorting as insurance. So, you can get S&P 500 or Nasdaq long-term put options for reasonable premiums out there. And a few of those are pretty good insurance policy. A SPY, Standard & Poor's 500 put that goes out into 2025 gets you over that hump of 2024 recession and bear market with a little bit of protection. So yeah, a lot of things could go way up when the Fed starts cutting aggressively, especially a lot of the miners. But until that time, it's kind of a dicey situation just in general with the markets out there. And I think this is a good time to learn about shorting and figure out how to do it and buy yourself a little bit of insurance.
All right, John. So that's some cogent points on maybe playing a little defense as we move into 2024, using options as a strategy, or even maybe looking at inverse ETFs as another idea, just to have some downside protection in case things do in fact get dicey. It's been a wild year in 2023. Odds are next year is going to be pretty volatile as well, but we'll keep following along with these markets. And we always appreciate getting your thoughts on how you're looking at the markets and individual sectors. If people like getting John's thoughts and want to follow along with them, definitely click on the link below. It takes you over to a Substack page. And John, as always, looking forward to our next conversation. And the next one will be in the new year.
Thanks, Chad. Talk to you soon.